Hello, I'm Ellie Dowding.
And I'm Lee Coates, and together we are ESG Accord and the Accord Initiative.
You're listening to Accord Talks, a podcast about sustainability and compliance and advice processes supporting the financial advice sector. We hope you're all well. Okay, so it's a really big hello today. It's episode 3. We're so excited to be here again.
Yep, feels great, doesn't it? And, exciting news, we're in the midst of putting together a mini-series for Accord Talks, which will be released during UK SIF's Good Money Week.
Yeah, I'm loving planning these, I have to say. So it's going to be a mini-series, a collection of 4 podcasts, and in true Good Money Week style, we've designed the series to support financial advisors in helping clients make informed decisions and better choices. So each episode that we're doing will feature expert insights from the FCA, the advice community, and leading voices from the fund management side and DFM sectors. So we're in the middle of recording these now, and can't wait to share them for Good Money Week. And actually, while I'm on it, to mention at the same time, we're also doing a webinar for Good Money Week with some brilliant colleagues on the 6th of October. That's the first day of Good Money Week, also featuring the FCA, and this will be on sustainability in the due diligence process. So let's get started with this podcast today. So our topic today, it's a big one. A drum roll, please. It's about where, when, and how to discuss sustainability and values with your investment clients.
Okay, but before we do, Ellie, I just would like to speak about some of the comments that we've received on the last podcast.
Okay.
So some people have been quite vocal, and some of them were rather interesting and quite revealing.
Okay.
Right? Okay. So the comments that really stick in my mind, and I'm going to paraphrase the comments here, basically said, one said, I've been in this industry for 30 years and I have only had 2 people who have raised the topic of responsible investment. And the other one quoted Milton Friedman, who stated that anyone who wishes to pursue the greater good can do it on their own time with their own money. So what's interesting about these comments is they both demonstrate a difficulty with understanding responsible, sustainable ESG investment, and perhaps a rather shocking lack of understanding of the requirements of consumer duty. Can I explain?
Yeah, I'm glad that you mentioned the feedback actually. So yes, please, I think we should. But I do also think that we have to keep it fairly short because we have to stay on track and keep to today's subject for the podcast.
Me do something short? Yeah, okay, I'll give it a go. Okay, right. So let's look at the first point. Only 2 clients have asked this advisor in the last 30 years. Well, actually, it's been a requirement for most of the last 30 years for advisors to demonstrate that they know their client. And this is done by good advisors asking clients, not clients asking advisors. So that's the first one. And then on the Milton Friedman quote, well, I suppose there's a bit of me that sort of agrees with Friedman. It isn't the role of business necessarily to be good, and anyone who wishes to pursue the greater good can do it in their own time with their own money. Okay, that's fair enough. However, if a client doesn't know that they can choose to invest in line with their values and their advisor doesn't raise the issue, how do they get their investments to align with their values? In both examples, I suppose, I detect a hint that the advisors concerned want to impose their personal views on clients rather than acting in a neutral way and actually finding out what the clients want.
Okay. Yeah. And I've been, I guess, sitting on my hands as you've been talking because I've got some comments as well now. First, I want to say firstly, that I love that we're getting comments like this. They might be a little negative, but what it shows is that our work is stirring the industry to think more about this important subject, which I think is great. But the point I'd like to add is that the Friedman essay, which by the way was 50 years ago, was highly polarizing, and it remains highly polarizing now.
Yes,
So
deemed to be quite holy in some
yeah,
circles.
on the one hand, some people think that businesses have a greater social responsibility, and on the other hand, there are people who think that the social position of a business is solely to make profits. And yikes, I think I can feel the tension just by saying that one out loud. And I think, yeah, emotive is certainly the word. But I think that this summarizes why all this can be such a tricky subject for so many people. And I think that people now, as we've moved 5 decades on, can perhaps now agree and see that the world has become a much more complex space. Businesses have become considerably more complicated enterprises, and that they now need to balance a multitude of priorities. And very importantly, I think this includes grasping that materiality is dynamic.
Okay, fair enough. Thought it was me that was just going to go off on one.
Yeah, no, no, I had to
Okay,
add that.
right. We're going to finish there
Yes.
for now. And I completely forgotten what it was you asked me to do.
Well, I think that what we've probably both just said does tie in directly with what was asked at the beginning, and it's about where, when, and how to discuss sustainability and values with investment clients.
Yeah, okay, right. So the first thing we need to do is quickly unpack the 76% statistic from the latest FCA Financial Lives survey and talk about what it means for advisors.
Oh, I'm going to need to quickly interject again here before you explain the statistic, because I just want to stress so that all our listeners are fully aware that the findings from that 2024 Financial Life Survey are from 17,950 respondents, which is a very big number.
Yeah, so it's not relatives and mates. It's quite a significant cross section
It is.
that the FCA went to. Right. Okay. So 76% statistics. What does actually mean? Well, the FCA survey results told us that, as Ellie said, from 2024, but it was released in 2025, that 76% of adults with any investments thought it important to be asked if they wish to invest responsibly when selecting a pension or receiving investment advice. Now, of course, it doesn't mean that many of those 76% want to end up investing responsibly. That's not the point. The point is that people simply wish to be asked. They want to decide whether to invest responsibly and not have that decision made for them without their knowledge by their advisor.
Yeah, it's so important. And it is interesting, I think, because many of the surveys that we see bandied about in the press about the advice process and if clients want ESG, the question is usually positioned for advisors something like, do you ask your clients if they want ESG? But the FCA survey framing for responsible investing, quite rightly, is so different to having an ESG question in the fact find. So the FCA terminology for the survey frames it as investing in what aligns with your principles and to possibly do well while doing good. So it leans to investing to reflect your values rather than it being about materiality or risk, which is where the ESG question would focus.
Yeah, and it all screams to me that advice processes, specifically the knowing your client process, really need to factor in asking clients about their preferences and objectives for their values. And this can be investing for sustainability, can be in conventional investing as a sort of a response of, I don't want sustainable, which is fine. Investing for ESG only for risk rather than ESG for saving the planet. Responsible or religious or ethical investment. And this does tie in with the interesting advisor comments we received that I mentioned earlier.
Yeah, I completely agree with that. But it's quite tricky, isn't it? Because none of it is as simple as it initially appears.
No.
And I think that's a very good segue to talk about the FCA's fact sheet number 21. So the FCA produced the fact sheet 21 for investment advisors, and it talks about knowing your customer and assessing their needs.
That is a really clever segue, Ellie.
Yeah,
Yeah.
yes, like we planned it.
Almost, almost.
Yeah. So yeah, it's a really good fact sheet, albeit short because it's only 2 pages. But what it does is summarizes good practices that the FCA has seen at firms when assessing client needs. So in it, the FCA suggests that firms should consider processes for capturing factual information, goal setting, and gathering soft facts. So on page 2, it's got a really useful infographic with the title, Are You Asking the Right Questions? And the infographic says, sometimes a core fact find may not be enough. Gather more of the customer's views and feelings to help assess their needs and produce more effective suitability letters. Then, as an explainer, sitting to the side of the main elements of the core fact find, the IHT questionnaire, retirement planning questionnaire, portfolio management questionnaire, that sort of thing, a couple of interesting client questions that the FCA have shared as good practice examples are: what are your political and ethical views when investing your money? And what would you like to achieve from your investments?
Yeah, okay, so it's really getting interesting now. Um, and let's break this down a bit more. So the
Mm,
FCA produced this fact sheet to highlight good practice. And here
yeah.
we have two great examples of good practice questions for clients that go way beyond purely financial objectives and consider non-financial outcomes and values. And importantly, the FCA highlight that these soft questions should be outside of the standard fact find.
Yeah, it's a good fact sheet for that. And it makes me think about the consumer duty actually, even though the FCA the fact sheet number 21 predates consumer duty. But the consumer duty really overarches and cross-cuts everything. So the FCA expects advisors to apply their rules and guidance with the consumer duty in mind. And this means that they should act in good faith to deliver sustainability related and other products and services, which means taking into account of reasonable expectations of retail customers. And they need to avoid causing foreseeable harm, which could include harm caused through greenwashing and recommending unsuitable products which might not align with religious values, for example. And they need to enable and support retail customers to pursue their financial objectives. And this can include where customers have sustainability related needs and preferences as part of their investment objectives.
Um, Great points, Ellie. I think it's quite clear now how a single question in a fact find asking if a client wants ESG or ethical is not really enough to know the client and their views, preferences, and objectives. What's interesting as we delve into this is that knowing your client is really quite different to assessing a client's attitude to risk or capacity for loss. We also see and hear examples from advice firms where they confirm that they do ask clients about sustainability or ESG preference, but it's only as part of their attitude to risk process. And that means they are probably asking the wrong questions and completely in the wrong place. Okay, it's fun time now, folks. This is a sort of mind games fun that we love here at ESG Accord. We've prepared a couple of thought experiments. Ellie's already giggling. A couple of thought experiments for you all, building on the theme of this podcast, looking at where, when, and how to discuss sustainability and values with investment clients. Okay, are you ready, Ellie?
Yes, yes, of course.
Okay, so I'm going to sort of throw the first one at you.
Okay.
Okay, so let's assume that an advisor asks the client about sustainability or values as part of their risk questionnaire process, trying to understand the client's attitude towards sustainable investing. Now, Ellie, can you
Yes.
explore the possible outcomes for a client who is asked whether they agree or disagree with the following statement? Bearing in mind this is in a risk questionnaire. So,
Yeah.
I would like hard evidence that an investment has a social or environmental impact before I invest.
Okay, I'll take some deep breaths.
Mhm.
Um, because deep breaths are needed because it triggers me a little, actually, because having spent last summer doing the CFA impact investing exam, okay, so this is because impact reporting absolutely requires the evidence and structured reporting. And as a compliance person who naturally loves process and governance, this statement to me makes me strongly nod and say, yes, yes, please, absolutely, yes, give me all the quantitative evidence. I mean, I suppose triggers aside, who would not want evidence when they're asked what their investment is achieving, be that financial or non-financial outcomes? But, and it's quite a big but, where does this question lead for retail investors in secondary markets and mainstream funds? That's the quite interesting bit. So it's the need for evidence wording that I think is a bit tricky. In order to get quantitative evidence, you have to have the environmental or social investment areas that produce quantitative data. This can be challenging to produce. It all sounds simple, but the issue is whether that data fully exists and if it's sufficient. So for a client, in theory, agreeing with this quantitative leaning question, they are going to end up likely end up in a GHG emissions related product where the data is more sufficient and reliable. So the identified client need for quantitative data may end up driving the outcome because other areas may not be so easy to obtain meaningful data on. So I've got mixed feelings on this question.
Hmm,
I
I
mean,
think
the
I can
question,
tell.
yeah, I mean, the question by its very nature drives a yes answer, I think, but it limits the scope of the product selection by its nature as well. I mean, what sort of absolute data would be needed for social issues? It's a very difficult area.
Yeah, I think I have an urge to chip in here.
Yes.
I mean, I'm looking at it from an advisor's perspective here.
Mm,
Okay, so you you don't you don't really want to be asking clients a question where a yes answer delivers dead end results in the due
yeah.
diligence process. You've got to see everything through from fact finding, know your client through due diligence, and then deliver outcomes. And it's an interesting question. In principle, but it really is asked in the wrong way, in completely the wrong place.
Agree. Okay, moving on.
Yep.
I've got a question for you now, Lee. And
Ooh.
yeah, what I'm going to do is mix a few example questions that we've heard from firms that we work with. Okay, so here it is. Would you be happy asking a client if they are prepared to take additional financial risk or being happy to accept a lower financial return to achieve social or environmental outcomes?
Whoa. Okay. And I think that's a mic drop situation, that one.
Hmm.
Um, okay, thanks for that. Oh dear, where do I start on this one? All right. Okay. I think the real problem with this is pretty much less than subtle inference that somehow investing responsibly or sustainably is going to carry more investment risk. I mean, setting aside highly specialized narrow investment funds that are out there and just looking at sort of mainstream strategy, sustainable, ethical funds, etc., there's absolutely no evidence that clients take on greater investment risk by investing in line with their values. There might be a different level of volatility, perhaps at different times in the market cycle, but fundamentally no measured additional risk. Therefore, by asking a client if they want to take on more risk, especially when you're in the middle of an attitude to risk um, questionnaire process, it implies that the additional risk is there. Um, and okay, let's forget the lack of evidence at the moment. This question in itself is potentially causing consumer duty problems, especially if one looks at the issue of sludging. And we love sludging. No, we don't love sludging. We love talking about sludging here, and as mentioned in consumer duty. So, I would argue that by asking a client this question, it is potentially trying to steer the client away from a direction that they would otherwise have wanted to take. Now, it's probably not intentional, but nonetheless, planting a level of doubt in a client's mind, which will be difficult to back up with any meaningful data. So, in other words, if the client comes back and says, well, how much risk relates to how sustainable I am? I mean, that's an impossible, absolutely impossible question to ask. So, if an advisor is going to use this question, and I really would strongly urge them not to, but if they're going to do it anyway, then to avoid any accusation of sludging, i.e. raising a question which is going to potentially steer the client away from what they wanted to do, I'd suggest that they add the following additional question as part of their main attitude to risk questions. And that question is, would you be prepared to take on additional investment risks by investing in funds that cannot demonstrate they are taking account of the market risks posed by climate change?
Mm.
Now, I can imagine that there's swathes of advisors listening to this podcast now who would be really uncomfortable asking that question as part of their attitude to risk. But then they should be equally as uncomfortable as asking the original question, are you prepared to take on additional risk by trying to be nice? Um, invest sustainably. So in either case, really, don't use either question. No advisor wants to be seen to be leading the client. It isn't good practice and it doesn't meet Consumer Duty's informed choice requirements.
Yeah. Oh my goodness. It's super interesting, isn't it? So
Mm.
yeah, I've had to hold back several times, leaping of lots of examples and extra
Aha.
points here. I love it. And it's exactly, as you said, Lee, it's exactly the kind of conversations that we love to have behind the scenes at ESG Accord. Most days actually, and it's one of the
Yep.
reasons why we wanted to start the podcast. So brilliant stuff. So swinging back into the topic, it's this is all great, but if a singular question is not the right way to know sufficiently about a client's values, preferences, and objectives, and neither is bunging in some random question to the risk questionnaire. Where and what then is the best way to meet good practice on this?
Okay. Well, we can only talk and explore this from our
Yeah,
own experience here. And ultimately, I have to say there is no single
no.
correct way. I mean, each firm and network, um, they're all going to have their own way of doing things up to a point. So there will always be variations in interpretations naturally. And we know that there are certainly questionable ways, or let's say more problematic ways. And we've explored some of these to some extent already. But the right way? Well, I suppose a good place to start is by breaking down what preferences and objectives are actually available to an investment client. A client needs to be able to make an informed choice. And
Yeah.
the vast majority of clients will have no idea at all that they can invest conventionally or even what conventional investment is. It's just the term, I want to invest, I need to invest. But the client isn't expressing a need to invest sustainably or ethically or conventionally just by that statement. They're just simply saying they want to invest. So they have no idea what they're asking by asking that question. So first things first is to explain the different pathways available to a client. And we suggest a summary of the different routes. Think of it as like silos. So you've got conventional investment, the way it's always been done. And now you've got the growth in conventional investment with ESG as a risk underpin. You've got sustainability and you've got ethical and responsible. We suggest that a summary, simple client-friendly summary of the different sort of like headline options is given to the client for a new client before the first meeting, or for existing clients before they come to the next annual review meeting.
Yeah, I think it's really, really important that what is provided to inform the client is done in advance. It gives the clients a chance to have a think about it and not be under pressure to make a decision. Also, that you've got to make sure that the client knows that there are no right or wrong preferences. These are their own values. Um, and then let's think back, I suppose, now to where we started talking about the FCA's 76% statistic, where people just want to be asked about their views. Yeah, so this statistic is framed as investing in what aligns with your principles and to possibly do well while doing good. And then back again to the fact sheet number 21, the FCA recognised good practice to ask about ethical views. So with all of that, we go for the compliance processes now. What's the most important thing to do next after each client has been made aware that investments can actually align to their values using their preference choices? So yeah, it all comes down now to recording and documenting accurately on file.
Yeah, I mean, totally agree with that one. So let's assume that the advisor has sent a simple document. Funny enough, we have a free to access simple document to send to a client. But anyway, let's assume the advisor's sent that to the client for the first meeting or next annual review. So they're sitting down with the client. Did you read the document? Yes. Have you got any questions? So that's part of that, separate to rather the fact finding process. The clue is in the name fact finding preferences. In some cases can be facts, but mostly they're emotional. They're very personal to the client. So get the fact finding out of the way, sort the attitude to risk, and the next stage is to come back to how the client would like their money invested, and that references the information that was sent out. And this allows for the advisor and the client to discuss the outcome, weigh up if the preference pathway that the client wants to go down can be fully integrated into the
Yeah.
investment planning, and sub-pragmatism may be needed here. So the advisor can then balance the client's attitude to risk and capacity for loss with the desired investment pathway.
Yeah, I agree. And this is where recording informed choice and replaying it back to the client and understanding the client preferences becomes so important. So the advisor's role is critical in balancing and
Mhm.
understanding the client. For example, a real world high sustainability impact strategy, for example, may not end up being possible for someone with low investable assets and a low ATR.
Yeah. And of course, I mean, ascertaining how far the client actually wants to be involved from simply wishing that their investments lean towards sustainability, for example, they may want to add a few common screens such as tobacco or, avoiding high carbon emissions.
Yeah, I agree. It's an important consideration and it has some very important compliance considerations. So, another little thought experiment for you all right now. Let's say a firm asks every client if they want to invest ethically or sustainably. For all yes answers, the firm's approach is to ask each client to complete a lengthy and complex questionnaire on all possible combinations and avenues for ethical nuances and screens, etc. This is another thing we've seen on multiple occasions out there in the advice processes that we look at. So, Lee, I know that you love this one. Would you like to tell our listeners what the issues are for this?
Okay, so we're back down to the FCA's lovely consumer duty and the sludge practices.
Hmm.
So let's look at this logically, okay? And as a reminder, sludge practices are those practices which refer to policies or procedures that create unnecessary barriers and negative friction for customers, hindering them from taking actions that would be in their best interest. So it could be argued that a sludge practice may be requiring a client to complete an unduly complicated questionnaire to invest in line with their values. Now, we've addressed this within our Record Initiative Suitability Toolkit by adding a positive friction point in the preference pathway record document that asks if the client is happy either to let the manager make the decisions on how the fund invests sustainably or whether they would prefer to complete a questionnaire. Now, this ensures clients are making an informed choice, another informed choice, rather than being presented with a single option that they might find difficult, uncomfortable, or time consuming. Remember, for many clients who are asked about their preferences for the first time, it isn't going to be an epiphany moment. It's more likely to be oh, I quite like that. So can I invest maybe 25 or even 50% in a sustainable option and see how it goes? And of course, the answer is yes. The advisor can say, if that's what you want to do, I'm here to advise you and build suitable outcomes. And by giving the client this choice, to leave sustainability options to maybe the advisor's recommended manager, rather than forcing them to complete a long and complicated questionnaire, it's so much better for the client and actually so much better for the advisor too.
Yeah, I mean it's a very natural and small extension to the existing process, but so important. So I absolutely have to add a very important shout out here to all of our Accord Initiative partners. So, for those of you not aware, we have partners who support ESG Accord to allow us to provide a free to access suitability toolkit for advisors that includes template documents for firms to follow the processes that we've been discussing here. So, we hope by providing this that it's a really useful thing for the whole industry.
Yeah, yes, we think it is.
Yes.
Yeah, we spent a lot of time building it, and yeah, I echo my thanks to our partners for giving us the freedom to be able to not only spend the time to create the documents, but also to make sure that they're available free to advisors. So I think I'd like to add a little more before we start to round up the
Okay.
conversation. All right. So we touched on this in the last podcast and promised to come back to it properly in detail. And this is just a quick reminder about vulnerable clients. So we're not going to sink into that pit at the moment. We're going to do a whole feature podcast on this subject, but I would quickly like to say that where a client has strong beliefs such as environmentalism or those with a religious background, these could be seen as a protected group under the Equality Act. So let's think about that for a second. If these people have very strong views attached to their emotions and their lifestyle, then they could be considered, as I've said, a protected group. Now, if a client is recommended an investment strategy that they subsequently realize is not in line with their personal values, and I say subsequently realize because it's a situation where the advisor hasn't raised the issue, the client doesn't have the knowledge to know that they could invest in line with their personal values or religious views, then there's a risk when they find out that their money has been invested in ways that completely contradict their whole lifestyle, there's a risk of distress or anxiety. So by not asking whether a client has any values or preferences in a perverse way, there's a risk that an advisor may be creating vulnerability for some clients. And that's not a good position for anyone.
Yeah, I'm really glad that you brought this up again. It's a hot topic for me. So there are I think serious issues not only for the potential to create vulnerability like you've described, but to not identify climate grief or anxiety at outset as a driver for risk taking in order to achieve environmental or social outcomes. That's there as well. So these are big subjects,
Mm.
and I feel like we're only just circling it really. So yes, we definitely need the podcast. So back again we go, I suppose, to the importance for advisors here for strong compliance procedures and record keeping. It's such an interesting subject and really, really important. So that feels like, to me, a really good place to pause for today.
Yeah, we covered huge amounts today. Yeah.
Yes. Yeah. So what's the key takeaway? For me, it's this: it's asking clients about their values. It isn't a nice to have. It's a core part of delivering good outcomes, but it needs to be done meaningfully, not mechanically.
Yeah, absolutely. And if there's one action we'd recommend, it's this. Take a look at the free to access Accord Initiative Suitability Toolkit on the Accord Initiative
Yeah.
website. Review your client journey and check where, when, and how you're giving space for these conversations to happen. And bear in mind, it's not us telling you to create the space. The FCA, in Fact Sheet 21, have provided an outline of
Yeah.
where that conversation should happen. And it's not in the fact find, it's not in the risk, it's a separate conversation. And that can be really, really quick conversation. And whether you're making it easy for clients to express their preferences, or if you are accidentally building in barriers.
Yeah, that's such a good point. And remember that these preferences and values don't need to be perfect or fixed. It's about opening a door to the discussion and recording these choices with care. So, oh my gosh, as always, it's if this has raised any thoughts or questions, or if you want to share how your firm is approaching these conversations, we'd love to hear from you.
And you can do that anonymously if you want, and you don't have to make it public.
You need to
Contact
do
us
it
direct.
anonymously.
Yes, yes. Because if it's public, it's fair go. But we're here to help. In all seriousness,
Yes.
we are here to help. So yeah, that wraps it up. A lot to digest, a lot of opportunity, and we hope you'll take a look at the free to access solutions offered on the Accord Initiative website. And don't forget to subscribe to Accord Talks on Spotify and the other channels. And if there's a topic you'd like us to cover, and I'm sure you're all champing at the bit, ready for the probability one. But if you want an extra one, want us to talk about something, drop us a message via our website or LinkedIn. We'd really love to hear from you.
Yeah, thanks so much for joining us for Accord Talks, and thanks again to our Accord Initiative partners who make it possible for us to spend time producing these podcasts for you. We've loved it. We hope you have too. Next stop is our Good Money Week mini-series. We look forward to seeing you then.